Hi friends, welcome to Adda 24/7. We are in the Scholars series for BFM. Here we are covering all the important theory, numericals, objective questions, case studies. So watch the series till the end. And importantly, watch the complete series. Okay, let's start. Chal. We'll solve some new one-liners as well as one or two numericals today. Okay, important ones. The credit quality of a credit portfolio of a bank branch has shown deterioration. Which risk has arose or arisen? You can ask, call it arose. Let's not get into English, okay? So, which risk has arose? So, the credit quality of the credit portfolio. Credit quality has deteriorated. What do you mean by this credit quality deteriorated? Means what? See here. Suppose if there was a portfolio of mine which was having, let's say, 100 loans. Okay, let me write it over here. Let me write it like this. Last year and this year. Okay, so what happened was last year 100 loans of, let's say I was having 100 loans. Out of those 100 loans, 85 were, let's say, A plus or triple A. 85 were triple A. Okay, this year what has happened? Triple A is the best ranking, right? This year what has happened? Out of these 85, almost 65 or 60 only are triple A. 60 are triple A. Then where are others gone? Others have gone into, let's say, 30, not 30, let's say 20 have gone into single A, 10 have gone into B, and how much are remaining? 10. So 10 have gone into default, NPA, 10 NPA. Now this is what is meant by the credit quality deterioration. 85% of the loans were AAA earlier, now only 60%, remaining have gone down. So this is known as deterioration of the entire portfolio. We are not talking of a single loan over here. So this is which risk? Credit spread risk, counterparty risk, portfolio risk, or basis risk. Think of it. Firstly, for that you need to have the meanings of all those. You need to understand the meanings, right? Otherwise, how will you answer? So what is the meaning of each one? Think of it. Here, you must know the meaning of everything in CAIIB. Only then you can answer. So let me come to it one by one. Credit spread risk, I'll come to it later. Counterparty risk. What is counterparty risk? Counterparty risk is a part of the credit risk. Okay, I'll write it over here. See this credit risk over, it means it is of two types. Okay, generally of two types. There can be many others as well, but main are two types. One is counterparty and second is country. Okay, country. Okay, so these are the two risks. So this is not for the portfolio, this is for the individual. So now we are talking of portfolio. So B is gone. C, portfolio risk. Now what is the portfolio risk? Portfolio risk means your beta value goes up or down. Okay, your beta value goes up or down. Basis risk. Okay, now I'll keep A and C on hold. Basis risk. Basis risk is what? Change in the interest rates of assets and liabilities in different proportions. Means what? Let's say I'm having a loan over here, loan. Then I'm having deposit. Okay, let's say my loan rate is 9%. Last year it was 9% and deposit was, let's say, 7%. Okay, now what has happened this year? Loan has gone down by, let's say, 2%. So it has gone down to 7%. But the deposit has not changed that much. Deposit has gone down by 6% only. So earlier, how much was I earning? What was my NII, net interest income? 9 minus 7. So it was 2% NII. Okay. This year, what is my NII? This year, my NII is only 1%. So my income has reduced. So this is known as a basis risk. Whenever the rate of interest of loan and deposit change in different proportions, different magnitudes, that is known as basis risk. Okay. So this is also out. Now only question remains is of A and C, credit spread and portfolio. So what is the answer over here? Think over it here. Now, the credit portfolio of the bank branch has shown deterioration. Deterioration means this entire, all the loan gamut or portfolio we call it, it has gone down. So it is portfolio risk, correct? Credit spread risk means what? Credit spread, spread. What do you mean by this word spread? Spread means the difference between this loan and deposit. So it ultimately means this example which I gave you. This is spread. NII's second meaning is spread. Okay, so this, the real answer is portfolio risk. My portfolio has been hampered. Okay, clear? Got it? Move on. Okay. Which of the following credit rating model combines 5 financial ratios using reported accounting information and equity values? Now this is a simple one. Yeah, Z-score, JP Morgan's credit matrix, Credit Suisse credit risk plus, and standard plus solution. So this is from, see here, I'll give you the names also. See here, this Z-score is given by whom? Who can give me? Z-score is given by Altman, right? Altman Z-score. This is the most used model in the banking, but it's not only compulsory model. JP Morgan has also given this credit matrix. Credit Suisse has given credit risk, but now the funniest part is Credit Suisse does not exist now. It is purchased by UBS. The company which gave you the credit rating model has a 0 credit rating. It has gone down. It has become a default NPA. And it was purchased by UBS. That's a funny part about this European companies or US companies. It was basically a Switzerland company. Okay. So Standard Plus, this is by S&P, Standard and Poor's, S&P. Okay, so which one uses 5 ratios? 5 financial ratios are used by who? Comment section, comment section. Z-score, Altman Z-score gives you a combination of five ratios. Remember, Altman Z-score is one of the best models as of now. Okay. Of course, there are some shortcomings also for that, but Altman Z-score gives you 5 ratios and it can predict a company if it is going to be bankrupt in next 12 months. Bankrupt, that's what is at least assumed. Okay. Bankrupt in 12 months. This is the most important advantage of Altman Z-score. There are certain these weightages for this. Okay, we call it A, B, C, D, E 5 ratios or X1, X2 5 ratios. Okay, so there are certain weightages. Those weightages I'll show you whenever they come. Okay, lower risk implies which of the following? Means what do you mean by lower risk? Lower risk. When do I call anything as a lower risk? Yeah. Suppose let's say I'll give you an example. I'm investing in 2 projects, project A and project B. Okay. In project A, now let's say I'll be getting some returns from that project. Okay. For year 1, 2, and let's say only 3 years. So 1 to 3 years. In project A, I'm getting a return of, let's say every year I'm getting 2 lakh rupees. 2 lakh, 2 lakh, 2 lakh. And project B, 1 year I'm getting a return of, let's say 2.5 lakhs. Next year I'm getting a negative return of 1 lakh. Third year I'm getting a positive return of again let's say 4 lakhs. So which one will you invest? Now here invest means I'm not talking, somebody might be a riskier person, liking for the risk. So somebody might say, oh, I'll invest in this. Why? Because I'm getting how much? 4 plus 2.5. So I'm getting 6.5, losing this 1 lakh, but I can buy the insurance over here. By that I can save it. So somebody might be a riskier person. Somebody might be liking to take the risk. But generally what happens? Generally. So look at the options now. Low risk implies what? This A will be of low risk definitely because I'm getting a steady return over here, low risk. And this second investment is of high risk. Okay. So here I'm not talking about what to invest and what not to invest. I'm just talking about what is the high risk and what is the low risk. Higher variability in the net cash flows with lower upside and low upside and downside. So higher variability in the cash flows, B, right? Lower variability in the net cash flows with lower upside and downside potential means lower variability, lower upside and lower downside. What do you mean by lower upside and downside? See this. Suppose if I'm getting the returns over here, this is my average. Average. So if my returns are fluctuating like this, then I'm having higher variability. This to this much is my range, right? But if my returns are fluctuating like this, let me make it a different color now. Okay, hold on. Suppose if my returns are fluctuating like this, so this is giving me a shorter upside and downside. So which one will I prefer? I should always prefer this one, shorter one, right? So what will be the answer for this? So the answer for this will be lower variability with lower upside and downside. Next one, lower variability in the cash flow with higher upside. It can't be higher upside. If I am having lower variability, I can't have the higher upside. See, this lower variability means this upside and downside very less. Higher variability in the net cash flow with higher upside and downside. So higher variability with higher upside. So that is not a low risk product. Okay. So what is the answer for this? A, B, C or D? Yeah. What is the answer? A, B, C or D? Comment section. It is B. Okay. Low variability, low upside, low downside. Simple. Higher risk implies what? Now this is simple. You can definitely answer it. Get the answer. Okay. Give me fast the answer for this. Everyone, give me fast. Higher variability means what? Simple. Let me see fastest finger first. Who gives me the answer? Fastest finger first. It is D. Higher variability, high upside, high downside. Okay. Simple. Zero risk implies what? What is zero risk? No variation in the cash flows, low returns as compared to the other opportunities available in the market. No variation. The first example which I gave you, project A, 2 lakh, 2 lakh, 2 lakh. Lower returns. So lower returns. Zero variation in the net cash flow. Zero returns as compared to the other projects. So zero variation, zero returns. Low variation in the net cash flow and low returns as compared to the other opportunities. Okay, low variation and low returns. Then no variation in the net cash flows and higher returns. So no variation and higher returns as compared to the other opportunities available in the market. So what do you think should be the answer? Think over it. Logically, everyone think over it. What should be your answer? Yeah. Okay. What will I prefer? If I am the investor, what will I prefer? I'll always prefer this D. Why? No variation. I'm getting 2 lakhs every year and high returns, highest returns available. Other projects are giving me 1 lakh per year or 1 lakh 50,000 something, but this is giving me 2 lakh also and higher returns also. So this one I'll definitely prefer. But is this possible? Is this practical? This is impractical. This is not possible. Impractical. Why? Because if you are having no variation, if you are having zero risk, see, remember, the rule of life is very simple, or rule of investment is very simple. High risk, high returns. Okay. Return. So that is rule of your investment or life. Okay. So this is not practically possible. Although this is the most sought for, I'll definitely seek for this. Okay. But that is not the right answer. This can't happen. So this is out. Zero variation, zero return. If there is a zero return, why am I doing the business? I'm doing the business for returns. So that is also out. What about this? Low variation and low returns. Now low variation, what do you mean by variation? Variation means, as I gave you that earlier example, even though it is low, this. Then also there is a variation. This is a variation. So I don't want any variation. If there is a variation, it will imply low risk. It won't imply zero risk. So this is out. So the correct answer is no variation and low returns. This is a practical solution available. No variation. I'm getting only single return. 2 lakh every year. And low return. This will definitely fetch me lower return than the riskier elements. Okay. So the answer is A. If two investments are compared, which criteria is more appropriate out of following? Now I want to compare two investments. These are to be compared. So calculation of return. One having higher return is preferable. The return net of the risk, the gross return. So which is the preferable one? Yeah. Which is the preferable one? Okay. I think so. Everything is seeming to be the better one, isn't it? Same one. Calculation of return. If there are two projects here. Two investment means two projects, A and B. Okay. So suppose if I say, what have I to compare in A and B? Calculation of return. If how much A is giving me, how much B is giving me. One having the higher return will be preferable. Higher return. If B is giving me 50% return, A is giving me 10% return, I'll prefer the B one. The return net of risk, okay, and gross return. Now these two are the doubtful elements here. What are the correct elements? I'll give you the options. Calculation of return cannot be the right thing for comparing for two investments or two projects. Calculation of return won't give you the risk involved in each element. Here, in any investment of the investment project, you have to compare two things. One is risk and second is return. Risk and return. Both of them are to be compared. So the correct answer over here would be not returns only. Not higher returns only. If some project is giving me high returns but highly risky, okay, then it's of no use to me. Invest in those stocks, Z group stocks. Sometimes they go 500% up. Sometimes they go 500% down. So these are of no use. Return net of risk. That is the right answer. Return net of risk means what does it compare? Risk also, which is having the lower risk, and returns also. Moderate returns we call it. Lower risk can't have the highest returns. Okay. The gross return. Gross return means what? The total of these. Gross means A plus B. That is never done. Means I have to choose between A and B. I don't have to compare to club A and B, right? So the answer is C. The return net of risk, right? That is the right answer. Got it? If investment A provides return of 12 in each year for 5 years. Now investment A is giving me, let's say 12 crores. 12 lakhs, you call it any number. How much can you think? 12 for 5 years. Okay. And investment B is giving me the returns of, now look at the returns, 6, 19, 10, minus 4, 30 in 5 years. So B is giving me what? 6, 19, 10. So variation in this. This is what? Constant. Both the investments provide annual return of 12%. See this, returns they are giving me of 12%. Both of them. So what did I tell you earlier? Whenever you compare any two projects or investment, you have to compare two things. One is risk and second is return. So now here in this case, both are giving me 12%, right? Both are giving me 12%. So return is okay. So now I'll remove this return part because both are giving me same returns. So that is out. What about the risk? When the return is same, I'll compare the risk. The one with the lower risk I'll do the investment. So which one is preferable? Investment A, B. Investment A as a cash flow is regular with lesser variation. Investment B as a return is having highest return of 30 in one particular year. So one particular year it's giving me 30 crores, right? So now look at this. The doubt of the answer, many of you are already found out. That answer is investment A. But the question now is the answer this A or is the answer this C? Because both are having the same answers. Investment A as the cash flow is regular. So whenever you get such questions, you must always choose the answer with explanations. So this is the right answer. As the regular cash flow with lesser variations, right? So that is the right answer. In fact, it is zero variations. Okay, got it? Capital requirement of a business depends upon which of the following? Capital requirement. Look at it. Capital requirement. Capital means what? Remember, there are basically three things in any business. Three important points in any business. We'll see the next question. I'll give you that time. What are the three important points of any investment which are in your hands, which can be managed? So capital requirement of capital is one of them. Capital requirement of a business depends upon which of the following? Risk associated with the business, revenue model of the business, expected return on the investment, and all of the above. So requirement depends upon, now this capital requirement depends on what? Risk associated, revenue model, expected return, all of the above. What do you think? Yeah, it is. Risk associated means what? How much is the risk here? If my project is more riskier, I'll put lesser capital in it because there are more chances of my investment getting down, zeroized. Revenue model, right? How much is the returns I'm getting? If I'm getting better returns with a lower risk, then I'll put more capital in it. Expected return means basically this is how much returns I'm getting from that project. I'll calculate simple word. I'll give you IRR, internal rate of return. Okay, and all of the above. So answer is all of the above. Okay, capital requirement depends upon all these: risk, revenue, and expected return. This is what I was talking of. I told you now that three items are there. Let me show you. There is a linkage between the following: risk, return, and capital, and market conditions. So which of the three are linked? Which of the three? Which of the three are linked? 1 to 3 means 1, 2, 3. 1, 2, and 3. Risk, return, and capital. 1 and 2 only, risk and return. 1 to 4, all of them, market conditions. And fifth one, 2 and 4. So now many of you might be typing this C, 1 to 4. Because you are considering all of the above is the simplest answer, isn't it? But the correct answer is A. 1 to 3 only. Market conditions are not in your hands. Okay, you can't link while invest here. Here we are talking of while investing. Suppose if I am starting a company, do I know after 3 years what will happen? In 2019, even December 2019, December 20th, let's say 2019, did anyone think that the world will stop for next 2 years? 2021 COVID? No one. Because you don't know what is going to happen, what would be the market conditions in future. So while investing, you can't calculate all the things. But what you can do is, you can combine these first three parts, risk, return, and capital, and do some extrapolation and then do the investment, right? So that was a YT series for you. Now before going, we have a special Holi offer right now of 81% off. Okay, 81% discount. Plus, if you join the Mahapack, you get 81% off plus double validity, both. Okay, so join this AIM batch immediately, starting March 22. How to join it? Let me show you. Go to Adda 24/7. Okay, over here, click on JIB and CAIIB. Click on CAIIB June 24. I'll always suggest you to go through the app. In the app, you get 1% extra. Click on View All. See this AIM batch. You can already click on this AIM batch directly. You get ebooks, test series, online live classes, doubt solving facility, live and recorded classes, experienced faculties, counseling and PDF and notes. So recorded videos are also available. If you miss out on any class, you can definitely get back using the recorded sessions. And the fees, look at this. Click on Buy Now. Okay, click on Buy Now. Get the code, put the code Y432. Y432. Okay, click on Apply. Look at this, it's 80% off. Plus, if you go through the app, you get 1% extra, 81% off. So that's why join this AIM batch immediately. Also, you can join the Mahapack. In the Mahapack, you get multiple batches. Look at this. Plus, you are getting double validity. Means you buy for 6 months, you get it for 12 months. Again, ebooks are there, videos are there, test series are there, right? Ebooks, as I told you, it is ebooks subject wise. Click on subject, you get chapter wise. Similarly, test also module wise, chapter wise, you get it. All the subjects it's available. So that's why join this immediately. Okay, join this AIM batch right now.